Here's something that will blow your mind. For every legendary investment success story, there's someone on the other side who made what turned out to be a catastrophic mistake. The entire market system is built on this fundamental reality.
That's such a fascinating way to look at it. We always celebrate the winners, but rarely consider there has to be someone on the losing end of those trades.
And what really gets me thinking is how this completely challenges the efficient market theory. This idea that prices perfectly reflect all available information. It's just not how things actually work in practice.
Let me share something interesting. I was watching a chess grandmaster analyze his games, and he said success comes not from brilliant moves, but from capitalizing on opponents' small errors.
That's exactly the parallel I was thinking about. Markets aren't these perfectly rational systems. They're more like complex ecosystems driven by human emotion and behavior. And just like in chess, the winners are often those who make fewer mistakes rather than those who make brilliant moves.
The psychology aspect is fascinating. Even professional investors abandon their strategies during market panics.
Speaking of psychological factors, let's dive into these investment mistakes. One that really jumps out is this idea of closed-mindedness, when investors completely write off entire asset classes without even considering the price. Like in the late 1990s, value investing was considered completely dead.
And then we saw the same thing in reverse during the dot-com crash, right?
Exactly. And what's really interesting is how these biases persist even among sophisticated investors. Studies have shown that even professional fund managers exhibit strong behavioral biases in their investment decisions.
The institutional constraints make this even more complicated, don't they?
Oh man, let me tell you about 2008. Some funds had to sell perfectly good corporate loans at 30 cents on the dollar. Not because they wanted to, but because they faced margin calls. It created this incredible opportunity for investors who could think clearly and had available capital.
That brings up something interesting about market cycles. How do these institutional constraints interact with natural market psychology?
Well, that's where it gets fascinating. These structural forces like fund redemptions and margin calls end up amplifying our natural tendencies toward fear and greed. Research has shown that during market crashes, forced selling accounts for about 20% of total volume.
Let's talk about distressed debt markets. They seem like a perfect case study for all of this.
Oh, you're going to love this. The typical pattern is so predictable. During good times, companies load up on debt, convinced their growth will continue forever. Historical data shows that right before market peaks, corporate leverage ratios typically reach 65% above their long-term averages.
That seems to create the perfect storm of mispricing opportunities.
And here's what's particularly interesting about distressed debt. It's naturally anti-cyclical. The best opportunities show up when things look terrible. Studies have shown that distressed debt investors who bought during peak panic periods earned average returns of 25% annually over the following 3 years.
But even then, you have to be incredibly careful about your own potential mistakes, right?
That brings up one of the most dangerous mistakes: overconfidence in forecasting. Research shows that expert forecasters are only right about 47% of the time, yet most investors act as if their predictions are certainties.
You know what this reminds me of? That brilliant John Stuart Mill quote about how people accept they're fallible. Just not this time.
Exactly. And that's what leads to the biggest disasters, when people take on excessive leverage based on what they think is a sure thing. Historical data shows that roughly 70% of portfolio blowups involve leverage combined with concentration.
Speaking of ways things can go wrong, what about hedging strategies?
This is crucial. People think of hedging as this mechanical process, but there are so many ways it can go wrong. Studies show that during the 2008 crisis, about 40% of hedging strategies failed to provide the expected protection.
That makes me think of those complex credit hedging strategies that imploded during the financial crisis.
Right. Even sophisticated institutions with huge risk management departments got caught out. The data shows that correlation assumptions used in their models were off by an average of 50% during the crisis. It's a perfect example of how models can fail exactly when you need them most.
So how should investors approach risk management, given all these potential pitfalls?
I think it comes down to this fundamental shift in mindset. Instead of trying to be brilliant, focus on being consistently less wrong than others. Research shows that investors who focus on avoiding major mistakes outperform by about 4% annually compared to those who chase exceptional returns. And
That seems to require a very specific kind of temperament.
it really does. You need this combination of skepticism toward consensus views, awareness of your own biases, and the humility to admit that your predictions might be wrong. Studies show that investors who regularly review and acknowledge their mistakes outperform their peers by nearly 3% annually.
Do you think that's why so few investors consistently outperform over long periods?
Absolutely right. The data is striking. Only about 10% of active managers outperform their benchmarks over 10-year periods. And what's fascinating is that the successful ones tend to share these common characteristics. They're highly disciplined, they avoid major mistakes, and they're willing to look foolish in the short term.
That brings us back to the psychology aspect we started with, doesn't it?
And here's what I find most fascinating about all this. Successful investing isn't about being a genius. It's about being a student of human nature, understanding these patterns of behavior and having the discipline to act on that understanding when others can't.
So in essence, it's about managing our own psychology while capitalizing on others' psychological mistakes.
Precisely, and that's probably the most reliable path to success in the long run, because while we can't control market movements, we can work on understanding these patterns of human behavior and building the discipline to act on that understanding. The data shows that investors who maintain consistent strategies through market cycles outperform by an average of 5% annually.
That's quite different from the common image of the brilliant investor making bold predictions about the future.
And that's exactly why it works, because while everyone else is trying to be a market genius, the real opportunity lies in simply being less wrong than others more consistently. It's not about being perfect, it's about making fewer mistakes than the crowd.